Hello, everyone. It's Tony Malik here with Empowered Business Coaching. Welcome to today's webinar, Increase the Value of Your Business by 71%. It is my goal and hope in the next 45 minutes that you will receive some invaluable information on not only how to improve the profits of your business today, but to dramatically increase the value of your business and net worth in the future. The contents of this webinar are based on the book Built to Sell, written by John Warrillow. And John himself started and built a couple businesses and sold them, and he self-admittedly made every mistake in the book in doing so, and was able to develop a way of building a business that would maximize business value. And one of the things he did is he researched literally thousands of business transactions and found that, and based on that, also developed an assessment called the Value Builder Score, and was able to prove statistically that businesses that scored 80% or more out of 100 sold for 71% more than the businesses that did not, that were below 80 points. So there was a lot of statistical proof that working on these value drivers does in fact dramatically improve the value of your business. Now, one of the misconceptions that most business owners have is they think that if they work strictly on the profits of their business, that the business will get maximum value. There's a particular bank out there that likes to use the term, you're richer than you think. I like to tell business owners, you may not be as rich as you think if you're not working on those 8 value drivers. There are factors that go beyond the financial performance of your business that can affect the value of business either in a positive or negative way. So what we're going to do is we're going to focus on some of those value drivers, but just a couple of things about myself, just to spend a moment. I've been a certified professional business coach for 5 years. I was certified by the Professional Business Coaches Alliance, and I spent about over 25 years training for this position. I managed business units in the corporate world, usually in the $3 to $10 million range, which included being a sales manager, branch manager, regional manager, looking after everything from sales, operations, bottom line management, as well as I had 2 of my own small businesses in the Langley area, which helped me learn the trials and tribulations of an entrepreneur. In my spare time, I'm involved with Rotary. I'm the current assistant governor for at least this current year in year 15-16 for the Rotary International Langley area, as well as I serve on the manufacturing committee for the Surrey Board of Trade, and you can usually see me at some events around town volunteering for various events. So one of the misconceptions that business owners have is what we call the owner's trap. And this is a business where that is really centered around the business owner. And this is often where the business owner does a lot of the selling themselves. They offer, quite often the businesses offer too many things. They might have had a request for some product or services, so they just start offering it rather than staying very focused on really what's the strength of the business. There is usually quite often the owner is the only one capable of or offering some of the services, or at least some of the high-end services, and the owner is the one that seems to often be the one to interface with the customers. Signs that you may be in an owner's trap is the business seems to slow down as soon as you leave, within a short amount of time if you're away from the business. Customers are always calling you when something goes wrong. And the revenue has probably reached a plateau. It just doesn't seem to get more than, it can't seem to go beyond where it is. And quite often the business owner is the bottleneck and prevents growth of the business. So if you're experiencing any of these, it's a good chance that you're caught in that owner's trap. And that can adversely affect the value of the business, because if the business is really reliant on you, a new owner coming in may find it very challenging to keep the business sustaining at the level that you had it at. So to create a valuable business, it really needs to be free of the owner as much as possible. So there's a few factors in that. First of all, the business should be scalable, meaning that the business can uh, uh, grow beyond the owner and also grow beyond its size in a systematic way that doesn't require an abundance of investment. Business owner obviously or business valuable business should be sellable, should be able to sell at a high value. And quite often, what the business owner can do is, if they really want some freedom in their business and to create a valuable business, the business should be built in a way that they become more of the chairman of the business. So they provide the ongoing strategic direction and governance for the business, but they should have a strong team of people that can run that business on a day-to-day basis and fulfill the vision and the goals that the owner has set. Of course, part of the plan may be to also pass it down to to future generations as well. So having a business that is saleable is a valuable business. So you may not want to sell it. You may not be planning to sell it for years, for even decades. But having a business is like owning a home. We may not want to or intend to sell the home or house in the near future, but we always like to know that the home is building value and net worth for us down the road. So a business is no different than that. So what I'm going to be doing is spending some time just reviewing the 8 value drivers that can have a profound effect on the value of your business. And we'll spend a couple of minutes on each so you have a bit of an idea of what each one is and how and why it could affect the value of your business. So the first is financial performance, which is the one that I think most of us tend to focus on. So we have to look at our business from the eye of a financial buyer, the buyer of our business, and they're going to look at it a lot differently than we just may have looked at it ourselves. One of the things they're going to look at is, okay, our financials may show that we're generating a certain amount of income, but they need to understand and be comfortable is how much of that income or will that income generate in future years. When a buyer is buying a business, they are not buying the equipment or the assets. They're buying future cash flow and future profits. Now, the equipment and the people and all the things surrounding that have to come with it to generate those profits, but the value of the business is going to be based on the amount of cash that the business is generating. They also have to look at how reliable those estimates. So one of the things they're going to be looking at is the reliability of the information and the risks involved. So one of the key words that I'll be saying a few times during this presentation is the word risk. The more risk there is to the likelihood of those profits sustaining themselves, the more risk there is, the less value a buyer is going to give to that business. Now, there are a number of ways of valuing a business. There's probably 10 or 12 that are quite common, but they all kind of boil down to this. When somebody is buying a business, and again, they're buying future profits. Now, if a business was generating a pre-tax profit of $100,000 per year, somebody doesn't necessarily want to does not want to pay $100,000 to get $100,000. They want a return on their investment, so they're going to need a discount off those profits to give themselves that return on investment. Now, a couple things factor into this. Is not only is what's the desired return on investment, what is the risk factor? A person that wants to invest in a business can invest their money in mutual funds or other investment vehicles and maybe make 5, 6, 7% in a relatively safe or lower risk type of investment. Putting all the eggs in your basket, being your business, is a higher risk because it's less diversification. There's a lot more factors that can affect their investment. So they not only want to have a decent return on their investment, they need to add a risk factor for the fact that they're taking a higher risk. So they may, for instance, want to double their return on investment from 7 to approximately 15% to get a desired return on investment for the risk that they're going to be taking. So when they buy $100,000 in profits, they will probably want to about 50% off, and to give themselves a 50% return on that investment, they're going to need to buy that first years of $100,000 for about just under $87,000. And then each year the likelihood tends to go down. So the next year of profits they're going to buy for 75,000, and right through to 10 years, uh, it's like a declining balance. The further in distance of time we go, the more risk there is as to whether that $100,000 is still going to be present or not. So a business generating about $100,000 a year in pre-tax profit at 15% discounted cash flow would be worth just over $500,000. And of course, if you want to use other values or other methods, that's about 5 times of cash flow. But what if this business has a higher risk factor? Perhaps it's not as predictable. The value builder score is much lower, and a new buyer just does not have as much faith that there's going to be those profits are going to sustain themselves in the long run or even in the short run. So instead of paying you $87,000 for the first $100,000 in profits, that may go down to $66,000. And of course, after the end of the 10-year period, now we're talking under $200,000 compared to $500,000. So having risk in your business can have a dramatic effect on the value of your business, even though the profitability is good. So as we go through the 8 value drivers, you're going to see a lot of connection with risk, and what the value drivers are doing is actually helping you be strategic in reducing risk. So after financial performance, we have growth potential. And the growth potential is really talking about not only the industry growth, but what is the growth potential of the business? Can it be scaled up in a way that is it scalable and allows it to grow, without an immense amount of retooling and investment? Let's take a simple example of a photography business. And there's 3 things that has to do with growth potential. It's also known as the trifecta effect. And what it is, a business needs to be teachable in that you can teach others to perform the service. It needs to have a high degree of perceived value to the customer. And it's a process that can be repeated over and over again. So a photography business, if they were to specialize on weddings, may have, and again, at a score of 1 to 10, may be given a rating of about 7 out of 10. So it's fairly teachable, but there's a bit of a learning curve to it. But it does have a high level of value to the customer, so it gets a 9. But as far as being repeatable, hopefully it's that person's only wedding, so there's not a lot of repeat business with that client. So that would get a 0. So that would give a total growth potential score of 16. But what if we had other types of photography we were doing? Just to go right to the bottom is school photos, which tends to get a much higher score because, first of all, they're teachable. You can teach somebody how to take school pictures, teach them things about poses, how to engage the students, and the learning curve is relatively low. It tends to have a high perceived value to the clients, especially to the parents, as they want pictures of their children. And it's repeatable because you can literally get in repeat business year after year as the kids are going through school. So that would get a pretty high score, of about 27. So this type of a photography business that focused on this market would get a much higher growth potential score than some of the other types. So finding ways to make your business scalable and to systematize it in a way that will allow it to grow quickly and without a complete retooling will have a definite effect on the value of your business. So the next is the Switzerland structure. And what the Switzerland structure is, Switzerland itself is known as being neutral. It doesn't take sides, and it stays neutral in the spectrum. So what that has to do with business is where your business is neutral when it comes to not being too reliant or very reliant on any one thing. Businesses that are very reliant on very few suppliers represents a high risk, or at least some level of risk to a buyer, because if you don't have a lot of choice in how and where you get your product or service, you may be caught in some costing issues, or you could get choked off in supply issues and ability for your suppliers to supply you with what you need. So that is a risk to a potential buyer. A business that is overly reliant on too few customers is a very significant risk to a business. A general rule of thumb is if one customer is representing more than 5% of your total business, it starts to become a measurable risk. It may not be a big risk yet, but it starts to get measured. If you have customers, for instance, that are representing 20% of your business, and one of them was to leave for whatever reason, that would be a huge hit on your business. So to a new owner coming in, it's a very high risk to them to take over a business that has customers that represent a high level of their business or a large portion of the business, because again, their investment could be hampered very quickly. And also, number of employees, not a number of employees, but you're reliant on key employees. Businesses that rely on certain key employees for their viability can also be a high risk, because if that employee left, it could create a hole or void so big in the business that it could have a detrimental effect on the business. I know of a computer service company that was very successful for a lot of years and very well respected, but over a period of time, a lot of the technical knowledge and client relationships were based around one key employee. That key employee left, took a lot of the customers with him, and within a couple years, that once very viable computer service company was right out of business. So it's very important for business owners to be conscious of the number of suppliers that they're relying on, who their big customers are, and are they being overly reliant on one key employee, or even a couple key employees. The next is the valuation teeter-totter. And what that is, it's a relationship between the amount of working capital that an owner has to put into the business in relation to the effect that will have on the value of the business. As I said earlier, when somebody buys a business, they're buying future profits. But if they have to infuse or inject a substantial amount of working capital just to cover the daily expense and the daily cash flow of a business, that can actually reduce the value of the business, because the value is based on profits. If they have to add a significant amount of cash into the business, they need to get a return on that money as well. So to get the return on that money, they actually have to reduce the price or value of your business and then include the working capital to get to an acceptable return on their investment. So if there are things you can do in your business that, for instance, such as reduce inventory and keep your receivables in check, can have a very positive effect on your value of business. But if they're not kept in check, you may be disappointed in what's offered if a new owner has to inject a substantial amount of money into the working capital. Recurring revenue. Every business has an opportunity to have some level of recurring revenue. The security industry is a good example. A security company that is built on strictly installations, and let's say it's $1 million, it does $1 million a year of installations, it doesn't have a lot of repeatable business, because once it does this installation, it has to go find its next customer. A security company that's 100% reliant on that may have a value of only about $750,000. But if that security built its business on monitoring contracts, or what we call recurring revenue, its value could actually be the same $1 million, but based on monitoring as opposed to installations. That same $100,000 or $1 million company could be worth $2 million. In reality, just as a sidebar, a lot of security companies, the security industry is now paying 4 to 5 times the the top line recurring revenue or monitoring revenue, which is not based on profit, but on top line revenue, which provides a huge level of value to security companies. And the reason for that is its predictability. So if a company knows that it's got a stable client base that just keeps coming back over and over again, doesn't have to spend a ton of money on marketing and finding its new customer, that level of predictability has an immense value on the value of your business. There are actually about 6 levels of recurring revenue too. So it doesn't necessarily have to be to the level that a security company has, but if you have some level of repeatability built into your business, you can actually get a pretty good score on this value driver. And the number 6 level is consumables. So coffee is a good example. Is if you're in a business that people have to consume your product and keep coming back for more, that's a good level of repeatable business. You may not be always guaranteed they're to come back and buy it from you, but with the right marketing and level of customer service, you can have a very high probability that as that product as the need continues, they'll keep coming back and getting it from you. The next level is called the sunk money consumables. Nespresso or your Keurig is a good example where the consumer has to make an initial investment for a dispenser or to get into on a product, and then now that they made that investment, there's a high level of motivation for them to continue to use your consumable to get back their investment that they made on that initial piece of equipment. So have this type of repeated. So once they've done that, they've kind of married to you, or they're at least making a commitment to you to buy your product for a period of time, at least until that machine wears out. Subscriptions, having a subscription where people pay a fee, get a service for a certain amount of time, and then they can renew it and continue for a certain amount of time. So maybe, for instance, a magazine may be a 1-year subscription where you pay a fee and you get a monthly copy sent to you. There's a certain amount of predictability to that, in that what the revenues are going to be for the next year, and there's probably going to be data available that a certain percentage of people do renew, which also provides at least a reasonable level of predictability in the long run as to how many people are going to continue to use your product or service. There's also sunk money subscriptions. So it's sort of like the coffee machine where you had to buy a piece of equipment, then you use the consumables. There are products out there like Bloomberg where you have to pay up front, perhaps for a license or for some training or for software, but then you pay a subscription to keep using that product, or to keep using that product or service. So this is just a way to kind of tie in a client where they make that investment, and no one wants to see their investment go up in thin air. So there's a certain level of built-in loyalty to be sure that they're going to receive the value for that initial investment. And of course, there's the auto renew subscription. So this is something similar to the previous one where you have subscriptions, but this just automatically renews. Iron Mountain is an archive or file storage company where people will store, or companies or businesses can store their files off-site, and it could sit there for years and years, and every year it just automatically renews, and payment is usually done on credit card or through invoice, and it's just automatically sent out and to continue for another year at a time. So this can go on forever until the customer decides they want to cancel. And the first one, which is really was what we were talking about when I gave the example of the security company, are the long-term type contracts, or of course the cell phone industry is a great example of that as well. Although we've seen some changes in Canada regarding the laws on long-term contracts, at the same time there is a certain amount of commitment required, and that gives a high level of predictability, at least for a couple of years at a time, for a company, so that they can continue to build their business knowing that they got a very strong base already in place. So recurring revenue does play a large role in the value of the business. And even if you don't have a high recurring revenue model now, with some good strategic planning, you can build some level of recurring revenue into your business model and enhance the value of your business. Now we have monopoly control. And what this is, it's basically how you differentiate or how your business differentiates itself from the rest of the market. So how can you keep competitors at bay and going after your customers? It may be you have a specific type of product or service that no one else is offering. Perhaps it's at a lower costing with a good margin that allows others to that prevents others from getting into the market. Or if you've got marketing and a strong brand out there that really makes it hard for others to penetrate. So finding ways to create loyalty and brand loyalty for your product, and to make it harder for competitors to get into your market and go after your customers, can have a profound effect on the value of your business. Customer satisfaction, believe it or not, also has a very significant effect on the value of your business. We all want to provide great customer service, but to the eyes of the buyer, that level of service can have an effect on the value of your business. And there's a way of actually calculating that, and it's called the Net Promoter Score. And it's one of the value drivers. Depending on your score, can actually have again, as I said earlier, can have an effect on your business. And there's really three types of customers out there. And let's take an example here. The first type is your promoters. And the promoters are those ideal clients that come in often. You're their main, if not their only supplier. They're very happy with what you do. They see a lot of value in what you do. But more importantly, they talk about you to others, and they refer clients to you. The next one are the passives. These are customers that, and by the way, the promoters on a customer satisfaction survey would typically give you a 9 or 10 out of 10. The number of then we have what's called the passives. These are people that are satisfied with your service, but they don't necessarily go out of their way to talk about or refer you to others. They may not give you all of their business, but they are overall satisfied. And typically, they would give you a 6 to an 8 on a customer service score. And of course, you got your detractors. These are the people that they use your product or service. They don't see a lot of value. They look at it as a commodity, but and quite often you may not be getting near all their business, and they do little to nothing to actually promote your business and to refer you. So the way to get your Net Promoter Score is you take the percentage of your customers that are promoters, that sort of gave you a 9 out of 10. You completely remove the passes, and then subtract the number of detractors, and that gives you your Net Promoter Score. So in this case, if we have 25% were promoters, we forget about the passes, subtract the detractors, and we have a Net Promoter Score. So what does that mean? Well, let's benchmark it against some other companies. Companies like Amazon, their Net Promoter Scores in the mid 80s, Apple in the high 70s, Marriott's just over 60, Google's just over 60 as well. Whereas the average company out there has a Net Promoter Score of about 15. So it just shows that the companies that really, and of course I think we could all argue that Amazon, Apple, Marriott, Google would have a very high business value, very high multiple on those companies. So it's really an indication that by spending time on not only enhancing our customer satisfaction but measuring it, we can really improve the value of our business. And I would even would argue the immediate profitability of our business as well. So the last one, value driver, is the hub and spoke. And what I've seen in my own travels is a lot of small to medium businesses have what's called the hub and spoke owner, and that's the owner where they are the center of the wheel. They're the hub of the wheel. It means the customers want to deal directly with the owner. the employees all have to go through the owner for everything. The suppliers deal with the owners. So when you have a business that is based on has a hub and spoke model, they tend to be worth less than a lot of other businesses because a buyer is going to look at this and they're going to say, well, if I remove that particular owner and I replace that owner, am I going to, that owner's businesses was based on his or her relationships with all these stakeholders. There's a much higher risk that a new owner may lose some of these customers. They may lose some of these key employees, and they may have some issues with their suppliers. So businesses that, although they may be making very good money, may have a very low value to a potential buyer because of the high risk involved. So to build a valuable business, it's got to be a business that's obviously saleable. It's got to be scalable. As the owner, the more you can remove yourself from the business and work towards becoming more of a chairman of the business as opposed to the owner operator, and it's something that could also be passed down and moved on, is a business that's going to have the highest level of value. So I talked earlier about getting your value builder score. So where are you on that spectrum? Remember, companies or businesses that scored 80 or above do sell for 71% more. So the way you can get your value builder score and get some feedback on how to build your business in a more strategic way is, first of all, go to my website at empoweredbusiness.ca. On the top right-hand corner, there'll be buttons that you'll see a button that says "Find Out Now." And just click on it, follow the instructions. It'll take you about 30 minutes to do the assessment. It's not a frivolous assessment. It asks you some very good questions that require a bit of thought. And once you're done, you will immediately get a scorecard. And this scorecard will have your value builder score for the whole business. It'll give you the overall score. It'll also give you the individual scores for each of the 8 value drivers. One of the things I'm offering as a free offer, and I usually do charge $500 for this, is as a gift for spending time with me here today. You will get your a free 28-page report that'll give you a lot of inside information about your scores and what they mean to your business. And I will also be offering a free 60-minute consultation to review that report with you, so that you can walk away from that meeting with some instant action items to help improve the value and profitability of your business immediately. So if you're at all interested in getting your score, please do just go to the website, do the assessment, and you'll get some immediate feedback on that. If you have any questions about what we've covered today, you want more in-depth information about the value drivers and how they might affect your business, just send me an email at tony@empoweredbusiness.ca, or I'd be happy to hear from you. Feel free to call me at 604-374-5934, and I'll be happy to spend a few minutes with you on the phone and answer any questions you have. Thank you very much for attending today. I hope you found this webinar to provide some of that information that will get you thinking about maybe building your business in a different or more strategic way that not only improves your profitability today, but allows you to really improve your net worth and your nest egg for the future. So good luck. I hope to hear from you. Have a great day.